Call to order. And it looks like we have a quorum. Do we need to take roll to declare the quorum? Yes, we do.
Okay, Councilmember Wee.
He's here.
Councilmember Newsma. I think he's having.
Jonathan, can you hear us? I think we're still having problems with Jonathan being able to hear.
Okay.
He seems to be trying to figure it out. He said he might have to step off.
Okay.
Again.
Let's wait then. What can we do the rest of the roll call then?
I
Jess?
think Reed is here, right?
Councilmember Reed has
Mhm.
joined.
Yeah,
so,
Councilman Reed is here.
So we can just, let's take
Okay.
a couple of minutes pause and then I think, redo the roll call.
Okay.
Are we waiting for Jonathan? Is that it?
Yes, I think so.
Okay.
I wonder if he knows we can't hear him. I guess he does know. Just as he-
He can hear us, so maybe we can. Maybe he can hear us. Oh no, he can't.
No, I think we can hear him. He
Okay.
can't hear us.
He actually was frozen.
Yeah.
Oh, maybe he is. Anybody have his text? Can someone text
Yeah.
him?
I'll text him.
You might be able to send him a note too through here.
It looks like he just left the meeting, so perhaps he'll
He'll come back. Yeah.
try to sign him back on.
Here he comes.
All right, I think I can hear now.
Okay, you can hear us, Jonathan?
Sorry about that.
Okay, good. All right, back to roll call.
Okay, I'll read you the roll call. Councilmember Wee.
Here.
Councilmember Newsma.
Here.
Councilmember Kelly.
Here.
Councilmember Reed.
Oh, I'm sorry. I thought you called me first.
Committee Member Rikus.
Here.
Committee Member McMillan.
Here.
And Chair Livingston.
Here.
And also, Jess, I'm here. Melissa Wynn.
Oh, okay. Sorry, I called your name first. I thought I heard you.
Oh,
say
I didn't.
you were
Okay.
here.
All right. Very
Okay,
good.
we have a quorum.
Okay, so I guess we'll go to anyone here for public comment.
The only person I see is Doreen Price. If you would like to speak, please unmute yourself.
And yeah, Doreen, you're still muted if you're want to say something.
There it is. Thank you.
Okay.
Sorry. Yes. Hi,
Hi.
it's Doreen and Rebby. Just wasn't expecting to make public comment, but since you asked, the discussion around what to do with the funds that have been found from the general budget is near and dear in terms of perhaps focusing on issues that ARPA may be falling short of or needs help on, or with regard to programs in human services that could expand to include more of the vulnerable population that was meant to be helped and limited usually by the charity's ability or funding to provide services, and the pointing to the great need of having our own source of revenue, which I know Devon speaks highly of in terms of having revenue for the ideas we want to put forth and make happen. And so the revenue with a grant maker could be established with either these monies or reestablished. We used to have one in Health and Human Services, and they were dedicated to affordable housing, and that program could be expanded as well, besides bringing in a grant maker to include more contemporary issues that we have right now in terms of affordable housing and seniors aging in place. Naturally occurring affordable housing as seniors age and helping them stay in the community. It's a desire to stay in the community because of the expense and rentals that we see, and the stability and the ability to bring in income when you have a home is still attractive, but not yet executed. We've seen ADUs and other things, but we've yet to see efforts that were talked about but never accomplished concerning helping senior age in place, perhaps with also providing a rental option in their own homes. And it also keeps them young and vital and gives them purpose. So all these things could be taken into consideration in terms of justification, that it's not just dollars and cents, but it's in terms of what we want to accomplish in terms of our community benefits, which are innumerable and immeasurable when we begin to address the huge gaps that we have right now in trying to age in place in an economy that's been really rough, and also with regard to health issues and stresses that we've not seen before nationwide and as a community, and that pulling together with regard to helping each other is pretty essential in terms of priorities. And the moral issue, besides the legal issues, need to be addressed in how we spend our money. That's it. Thank you.
Thank you very much. And it doesn't look like anybody else is here for public comment. Is that correct?
That is correct. I don't see anybody else.
Okay, very good. Great. So moving on to the next item, approval of the minutes. Hopefully everyone had a chance to review the minutes from our August 9th meeting, and a motion to accept them.
I move that we approve the minutes from August 9th.
Second.
Okay.
Councilmember Weed?
Are you saying Win or Reed?
Yes. Win.
When?
Oh. Aye.
Sorry. Councilmember Newsma?
Aye.
Councilmember Kelly?
Aye.
Councilmember Reed?
Aye.
Committee Member Rikus?
Aye.
Committee Member McMillan?
Aye.
And Chair David Livingston?
Aye. Aye. Okay. All right, so they're approved. Okay, very good. Okay, so now on to our on to the rest of our agenda for consideration. Mr. Desai, the auditing services extension. I think you're going to take us through that.
Yep. Thank you, Chair Livingston, the members of the committee. I was just looking at our auditing services with the Sikach LLP, and I looked at their experience in some of those communities for a long time, and which are comparable to ours, like Elgin or Palatine, Naperville, Oak Park, Elmhurst. And at the same time, I just coincidentally, while I was doing the memo a week before that, I got the survey, which was conducted by the, I think, Northwest Municipal Conference or some other organization about the auditing and how long you keep or how soon you change. And I saw that, there is some consistency. Even some of them are, as I said, Sikach has been doing some audits for 15, 20 years. The thing is, they change the partner, the manager, and some of the senior people. And I think that has happened in our case, sometimes by force because of the lot of turnover in their Sikach. And sometimes we asked them in the past even. So obviously, we have a new partner now, Martha, who is kind of taking over from Dan Berg. And obviously, we have 2 or 3 different managers in the last 6 years. And so if you look at the last paragraph where other communities, when did you change the auditors, and you would see that Winnetka 2007, Streamwood 2013, Park Ridge 2019, Mount Prospect 2021. So they just changed it, but they are going to go for long. Morton Grove 16. Lincolnwood, they just changed it. Lake Forest and Lincolnshire 16 and 18. Highland Park 2012. Grace Lake 5 years back. Glencoe 15 years back. So I saw that one trend. And obviously, I know the people at some of those communities where the Sikach is doing their technical expertise, and they have over 100 municipal clients. And particularly in light of ever changing the rules of how we report, and all that. They are a big help. And in light of that, I thought that, okay, they've done for the past 6 years at least, and particularly, the other thing was the market. I heard somewhere that, if you go out now, you might see a 30%, maybe a jump in the price, for the auditing. So considering all those things, their experience, their knowledge, and their cooperation in helping us even somewhere where we need some technical guidance, of the upcoming new changes to our reporting. I thought that, okay, at least let me reach out to the, kind of recommend, bring it up to the Finance and Budget Committee for your recommendation to the City Council for a 3-year extension.
Right. And you're happy with their service?
I mean, we are extremely happy, and as I said, they don't have they are cooperative. Sometimes we reach out to them that, okay, what is this coming up? Because they include in their audit report upcoming GASB pronouncements, and how would that affect us? They're pretty good. And when we talk to some of these other counterparts there where they are doing the audit, and I had a good experience in Carpentersville for 4 years. So I'm all for it.
How long have we had them, Hitesh?
I think 6 years now.
So that would be 9. And when we originally had them, we did an RFP when we hired them. Were their prices in line with everyone else?
Yes. At that time, RFP was done and they were awarded.
All right. Anybody have any? It does sound like you've had some degree of partner rotation, which I know is something that we view more important than firm rotation. And there's such a cost to get somebody else up and going, just in distraction aside from money. So, anybody else have any thoughts or comments?
I've got my hand up, so I'll just jump in. I just out of curiosity, I think I'm happy to support this. But Hitesh, if you can just talk about why the team is extremely satisfied with them, and what are the qualities of in 3 years, whoever's still here, if we're looking for a new firm, if we're looking to maybe extend the contract even further, what are the qualities that we want to look for in a good auditing partner?
One quality which I said is that ever-changing auditing and accounting reporting requirements, and they don't have what I call like a gotcha. I mean, when we reach out to them, they would say that, yes, that we would recommend, we would suggest that, or this is how. I mean, sometimes some of the bond transactions, which are refunding or spread over different funds and refunding savings and all that. And yeah, I mean, they would help out and say, yeah, this is how, yeah, I mean, we would recommend you to kind of, move forward with that. I mean, 10 years back when I was an accounting manager, yes, we had a little bit kind of a problem with one of those the manager at the Baker Tilly, where they won't say what is needed from us. And we had like a back and forth, and it took like extreme amount of time just to finish up some of the schedules of this big audit report.
Okay. All right.
Okay, so what I think I'm hearing you say is that, sorry, there's noise in the background from the street, but I think what I'm hearing you saying is accessibility. And I don't know if I got lost in the sauce there in the explanation, but is that what I'm hearing? Accessibility is one of the key.
Not with their functional knowledge, their technical knowledge, and besides that, kind of to cooperative nature, that if you ask them the questions, yes, they would, because yes, we pay for them for the audit fees. We don't pay them if I'm calling them in the middle of the year in June or August or like that. But we would have a kind of a good discussion, and they would give their clear and the right opinion about the things, how to move forward with any of those.
Mm-hmm. Anybody else have any concerns or thoughts? Okay. Right.
If you're looking for a motion, I will make the motion to
Sure.
recommend approval of Sikich for another 3 years.
Second.
Okay. Have a vote?
Okay. Councilmember Nguyen,
Aye.
Councilmember Nuzma,
Aye.
Councilmember Kelly,
Aye.
Councilmember Reed,
Aye.
Committee Member Likas,
Aye.
Committee Member McMillan,
Aye.
and Chair Livingston.
Aye.
Okay, thank you. Let's see what we have.
All right. So on to the first discussion item of the GO bond versus line of credit and materials you circulated.
So again, thank you, Chair Livingston. I think the last time committee asked me to reach out to the, a couple of line of credit options, and at the same time have a latest geo bond thing, because once we got a couple of June, I think from the month of June. So what I did is I have attached 2 line of credit offers from Byline and Wintrust. At the same time, the report from our financial advisor as of, I think, September 2nd. So, and you would see that obviously the rates are expected to go up. I was reading Wall Street Journal today with the inflation pretty much staying right where it is. Yes, those line of credit would go up at the same time. Geo bonds rate, and at the last line, if you read that, besides that CIP fund has a balance of around over $10 million. So, and I talked to Lara, who is our city engineer, and I'm like, how about if we wait till the market kind of stabilize, still kind of, say like a late spring, and we issue the bonds at that time based on the needs and the environment. And we could combine our 22 needs as well as our 23 needs. And she was okay with that. I felt comfortable too that yes, we can kind of delay it, until the next spring. And obviously the scenarios, more or less the numbers are same. If you look at it, yes, he did mention that our financial advisor that the market had improved a month back, where it looked like, okay, we have an edge over the line of credit, but then it went bad again. And so pretty much now is the, same as the line of credit, or even little worse, maybe by 5 or 10 basis points. But again, yeah, this is where I seek a direction from the committee about their thoughts.
Okay.
I guess, Hitesh, first of all, I think we need to decide if we really need to issue any bonds. I think we need to get a better handle on our surpluses, certainly, before we think about bonding. And I think, going out in this market, I just think it's somewhat treacherous. I've sat in economic meeting after economic meeting, and I think rates are going to be not advantageous at all, at least with a line of credit. If we use that, and then we have some fiscal discipline, we could, hopefully pay off the balances. And also, we're not funding short-term needs with long-term debt. I think that, most economists at this point think we're in for at least a soft landing. Many of them think we're heading to recession. So I think anything that can be cut out of the capital budgets, frankly, should be. Until, things that we don't have to do, we should tighten our belts and, be responsible that way. Yeah, I think it's what we're probably all going to do first.
Right. I'm sorry. I mean, you're right. I mean, what would happen if we, say, wait until the next spring? We would have a couple of things by that, or maybe more. We would know about the budget 23, which would go to the council discuss. We have a special council meeting next week about the CIP plan. So we would have clarity on the CIP projects to move forward in 23, And obviously at that time, we can decide that, okay, City Council, this is what you have decided, you directed us. And so we have the kind of pretty much, we know the amount, that what are we moving forward with.
Yeah. Hitesh, I have a question, and I apologize. I'm in my car. Is there any non-use fee on those lines of credit?
No.
Yeah, but I looked at one. And one says, the one from Wintrust says the funds must be drawn down on the facility through October 17th.
Yeah.
I mean, they have it. I mean, they can be flexible. The only thing is right now, yes. I mean, I have talked to them, and what happened is considering the rates and all that, we are going to use a byline for the line of credit. I think council just approved last night for property tax purpose. But again, I mean, I can go back to them if we need it. So yeah, I mean, I'm constantly kind of on the top of that. The property tax status, how about the fund balance in various funds? As I said, I think in my memo.
Hitesh, Hitesh, speaking as a banker, banks are very interested in deposits right now. So I think if you can probably go back and negotiate pretty hard with any bank that you have deposits with, because that's becoming a scarce resource right now for banks.
Yeah,
absolutely. Yeah, we have Leslie. There's a minimum too. We have to keep 20 million at Wintrust and 25 million at Byline. So.
Right, but I guess my point is that going back and no, we don't want that drop provision, or no, we don't want a non-use fee. I think you're going to have some success negotiating that because banks are so desperate for deposits.
Right, but at least one thing I mean, hearing you guys and that yes, I don't know, the market is right. Even today, we talked about this for the last couple of months, and at least we have kind of a decent fund balance in CIP, which we can draw upon and use it until and we will keep an eye. Yeah, I mean, I can update you. We have a monthly meeting working with the financial advisor at what's going on the long-term market, GeoBond, as well as some of you are in the banking industry. You would know that, how those rate environment for the line of credit.
Yeah, and just listening to the economists, I mean, I just think our fuel prices are going to be really high this winter. Heating people's homes is going to feel like an additional tax. So I think we have to be very mindful of not trying to increase the levy, not increasing bonding to the extent we possibly can.
Yes. Absolutely, yes. So, I mean, yeah, and that's why I put the scenarios. I put that one last line about the fund balance. And I mean, I would like to hear from others too, that what they feel about.
So it's Atesh, I had a couple of questions. What do we earn on this on the balances of cash that they're asking about? What do we earn?
We earn right now maybe a 2.5.
Are we that much?
Oh yeah, I mean we have a special deal.
Okay. Okay. Maybe you could get back. That seems pretty high, but so we're talking about.
No. I mean this is the deal. You can just check anytime. Our deal is there are two state pools. Like we have one pool called Illinois Fund run by the state government, treasurer of the Illinois state, and we have a deal with both the banks to give 5 basis point plus Illinois fund rate.
Okay. So we get about 2.5%. So
I mean, I can check the Illinois fund rate today, and yeah.
Okay, that's fine. I think that to the point I think Sherry made. I mean, I view this as more as there's a place for a line of credit as a permanent part of our structure, because I think one thing we want to get more used to is not doing a bond deal so we could put more cash in the bank. Right. The advantage of a letter of credit is that it's more flexible as we have ups and downs in cash flow. When we're positive, when we get our tax receipts, it's something that we can immediately pay off. So that's the real benefit of a sort of variable rate, permanent instrument in our capital structure is you use it when you need it and you can draw it down when you don't need it.
Right.
So even if it appears to be, the same sort of rate as a long-term, which I think that's very transient. That's not the normal situation. We're in a very unusual situation, but a big savings of having some sort of short-term variable rate instrument is being able to just take it up and take it down, as opposed to, we issue a long-term bond now, that money's out there for 20 years.
Right.
So I think that's the element of the term sheet from Wintrust, that's not really what I was envisioning. I was thinking more if we have maybe in a longer term facility where we have 15, 20, 25 million, maybe a bond deal in effect is substituted with a letter of credit that we can draw up and down as we need to.
Well, that's kind of byline is that, it's like that it's a touch more of a rate, but they seem to have, it's no closing or unused commitment fees. So it's almost like if we don't use it, we don't use it. The only thing I had one little worry about was it says the term is 1 year, principal is due at maturity. So what happens 1 year from now if for some reason would they renew it? Let's say we're 3 months short of paying it down.
Right.
That's the only concern that I had on that one.
The reasons why banks want to keep lines of credit like this short is because they still, even though it's not drawn, they have to apportion capital, which is how they justify a non-use fee. So I'm wondering if what they're really sort of saying is it's an uncommitted line for 364 days, and then we just roll it every year. That would be kind of common practice.
Okay.
And that is what the problem is. And I know in 2020, right during the COVID, in May 2020, we took a 15 million line of credit with the byline for a 1 year term, considering the grave situation. And we never used it even at that time. And this was the same discussion when I started with byline and Wintrust, talking about non-use fee, just like what Leslie said, exactly those things. That it is, if we do that, if we keep these funds available, that costs us some money, If you are, and even this time for property tax, when I took it, I told them that I may not use it. I have some money. I might do interfunds where possible without touching some of the funds, or I might be using the very little, not 15. Could be using. So
But Hitesh, they make a lot of money on the deposit side. That's why you could argue to keep the non-use fee out of the picture.
But at least at the same time,
CRA looks good for them to help the community. So
we have the special rate, as I said. Like right now, I'm looking. Illinois fund rate is 242, 241, so plus 5, so 246. Now,
Yeah.
I mean, and these are the checking accounts, so no bank would give this kind of a rate.
Mhm.
Well,
Okay.
they're still making money on it.
I
Yeah.
mean, yes, but at the same time, and I mean, it's a good, it's a win-win situation, you know. And
Sure.
and my thing
Yes.
is, as to your point, Chair Livingston, I heard you last time to some of those members that I see that you guys feel like that. Okay, we should have some kind of a variable
Yes.
financing in our kind of a, what you call financing thing. So what I can do is when I'm going to come up with this, what do you call it, this byline line of credit, $15 million, and after 4 months, 5 months, whenever we get the property tax money, yes, I mean, I've already kind of touched on that subject with that we're looking for some kind of on an ongoing basis, you know, for a longer term,
Yeah. Right.
15 million of line of credit. So, and I think they would be okay with that. Yes.
Yeah.
Hitesh, is byline your choice? Would you pick byline over Wintrust for the line?
I mean, I see the rate. The other thing, the byline is choice is we have all the operating accounts there. So sometimes it's a lot easier to move the money from one fund because we have 35 different funds and we have to work according to that. I cannot touch some funds which are federal government and ARPA and CDBG and all that. So yeah. But
and the one
obviously,
on Wintrust says funds must be drawn on the facility through October 17th. So I don't know if they're expecting us to use it all by then.
Yeah.
And we're not going to. So maybe byline is the right option.
Right. And I see that Wintrust, they kind of, they express their thing that, it's hard to kind of, you know, go too aggressive, particularly without the unused fee.
So I think Councilmember Reed had a question. Maybe his hand was raised briefly, but maybe not now.
No, I accidentally dropped off and run back. You might have just seen my name pop up when that happened. Thanks for checking in.
Sure. So Hitesh, one thing I would press on is this term. Is there a longer term? I would say even if you end up with a fee, ideally not. But is it extendable? Is there an automatic extension period? That is the, you know, I would just investigate that further. I know that at my place of work, we're renewing our credit facility now, actually doing a 5-year deal, but we're different, certainly a different animal. But even a 364-day is generally extendable out a year or two for a corporate issuer. Just wondering what sort of automatic extension sort of make sure we don't end up with a liquidity problem.
I mean, we had this in the past, like a line of credit for a long time, and we used to renew it every year for our TIF funds, you know. So I can definitely, and I've touched on that, and I can bring it up to the bank.
All right. Okay. Good. Does anybody else have any thoughts? It seems like this should be part of our structure. I wouldn't just think about it in terms of bridging this delay in the property tax money. But again, to really save money using it, we've got to view it as a cash management tool and take it up and take it down as we need it, and not, even though we're getting a good rate on our cash deposits, we really don't want excess cash deposits, any more than we need for our liquidity. We want to borrow, aside from getting a good rate, we want to borrow as little as possible. Right. And part of that is not drawing money that then just sits in a bank account, unless there's a legal need or some other need for that.
So what's the process if we want to go forward with this? Do you have to bring it to council to approve, or do we make a recommendation?
So right now what happens is that I have a line of credit for property tax. So don't confuse that. That has been adopted by the council. This is where, how do we structure and what the committee feels about that. Okay, we don't want to issue bonds right now. Let's wait until March, April, and then settle down and kind of re-look at the thing, and I would come to the finance and budget committee, in 6 months and say, this is where we stand. These are the CIP budget. This is what approved by the city council for 23. And then we talk about the funding that piece.
Okay.
Don't we have to approve the line of credit first?
I mean, as I said, we will draw right now on our fund balance.
But aren't we? Are you saying you don't want to get the? Go ahead, Councilmember Newsom.
No, we can wrap up, and then I'll ask my question. We'll get the first one answered.
Okay. It tests, so I'm a little confused. It seems like, do you want to get this in place now in addition to that property tax line of credit?
No, I don't want right now because I have a 15 million line of credit there with the byline.
Okay.
I'm thinking for property tax, maybe I'm using 5 to 6 million. So there is a 8 or 9 million for an emergency purpose if I need it for CIP.
Okay. And you don't have a pressing liquidity need now to justify an incremental line of credit above the 15 that was approved last night?
Absolutely not.
So it sounds like we can continue to talk about this, maybe push on the bank in terms of long-term structure. And really the decision is the next bond deal, or when we have an incremental funding need, is that a line of credit or is that a bond deal? And we can look at what the credit markets look like at the time. And they could even still be a bit mixed up next spring, but they'll stabilize at some point, and you wouldn't expect that your short-term rate would be higher than your long-term rate forever, So that is, Jonathan?
What I was going to say into that, since we just approved last night a line of credit, is there a need? Would there be a need, even if we had, if we needed the money, would we have to open a second line of credit, or could we expand the existing line of credit?
You
we could expand, and as I said,
yeah,
right. And the one thing
I didn't catch the answer there.
I would tell
you
these
just
things.
expand the line of credit. You just asking for an increase. But I think to David's point, we want to see what it would cost to have it be, a longer term facility, because we want to have permanent line in place, I think is what we're all circling.
Yep,
David,
that's right.
mistaken.
I mean, a permanent line, whether we use it or not, as an alternative to, credit markets go, favorable and unfavorable quickly. So I think that's another.
And Jonathan, it would depend on what your
a backup option.
It would depend on what your deposits are as to how large the line could be. So you get an advance rate against, loan to value, basically against whatever assets you have in the bank.
Got it. Thanks.
And to council member, your question in terms of liquidity, that as I say, I have council approved 15 million for property tax.
Mm-hmm.
That is the kind of estimated second installment amount, but I might need maybe 5 to 7.5 million. The other 7.5 million would be there, in case we need something for the bond purpose. But considering the 11 million and IDOT is kind of so notorious in billing, for years. So yeah, I don't see any issues with liquidity for the CIP project.
I have a question with respect to IDOT. I know they're notorious for not kind of giving, people that you never know when they're going to want their money back, it sounds like. So from the time they come to you and say, we need a payment, to when you pay it, what are the terms? Is it 30, 60, 90 days? How does that work?
There is no kind of late payment from them. So yeah, we can pay them 30 days, and obviously we have the line of credit available, and their payments total outstanding is, I think, I'll have to check that, but yeah, it's around maybe $4 or $5 million, and we can always ask for the extension if we need, but I don't see that, IDOT bill coming due and suddenly, we don't have the money,
Okay, that's good to know.
Right, because as I said, I have some other funds so that short-term borrowing within the funds were permissible without touching any funds which are the federal grants or anything.
Okay, perfect. Thank you.
Any other comments? It sounds like you've made some good progress. We still have some time to press on things like the term and, again, forecast when we would actually need an incremental line. So anybody else have anything to add on this point? Okay, good. So that was just a point of discussion, right? So I guess we'll go on to the pension actuarial valuations next.
I shared the actuarial valuations, one for police, which is like a 50-page, same thing for fire. And there is a 2-page supplemental because their actuarial valuation is based on a 6.25% assumed rate of return. And then based on the city council directions for the last few years, where they kind of like to see a 6.5% rate, they have given, I think, 1 or 2 page supplemental our actuary faster and faster. And so the numbers are there. What is the difference? At the same time, what I did is I sent you guys what's the rate used by the other community, And yeah, more than 75% communities, I think, are at 6.5 or higher, including the Illinois Department of Insurance. Some of those communities, you see that Schaumburg and others, they are at 7%. And even I was reading in our IGFOA, which is our finance officers, that with the consolidation in place for at least the fire fully, fire pension funds at the state level in terms of investment, and a little bit of a police pension funds, one of the communities kind of inquiring whether we should now raise our investment rate assumption, because it would be an efficient operation instead of 500 different pension funds investing on a single, on their own. Now there is a one body which is investing billions of dollars. So it's ongoing discussion. Some of them say, no, we will keep it where it is because we are at 6.75 or 7, Algon, Queen, Elk Grove Village, and some of those. So I was not comfortable with what we have been using. And Evanston is at the forefront, using 6.5 for many years. Even when Idaho Department of Insurance was using 7%. So I think we are doing pretty good job. The other thing, what we call is we are using 90% funding by 2040 on a level dollar. So instead of level percentage, because as the payroll increases, the amount of contribution increases. But we kind of estimate the amount and then go by the level dollar over the remaining life. So that helps, and at the same time, I think every year I bring it up. I can tell you, I think I did not include in that one that how much more we contribute than the state minimum. And this time, state statute and the actuarial reports is like almost a 1.75 million combined, higher than the state minimum requirement based on the 6.5% rate assumption.
Right, but can I just say the actuarial recommendation again is 6.25, right? So last year we went with 6.5. Why aren't we following the recommendation?
I mean, I don't know whether I should say the actuarial recommendation. This is more driven by the pension board. So pension boards have kind of said that we want 6.5. So the actuary would prepare based on that. And then I, on behalf of the city, asked for, as the city council has asked for last 3 years, that go with the 6.5% number.
I mean, I know that frees up more money for the city, but I think we're better off if we go with the 6.25 in terms of more responsibly covering our pension obligation. I'd also like to, not at this particular meeting, but I would very much like at our next meeting to address the potential of, again, that 90% was a range for communities, struggling communities. I don't know why Illinois did that, but at any rate, we should be paying. I know it's going to be a lot this year given the rates, but I would very much, given that we have a surplus, I'd like to see us consider here at this committee at our next meeting, really look at and wrestle with the idea of paying at 100%, not at the 90% interest. And that's why this has been ballooning over the years, why it's increased by $100 million over the last 15 years, because we are paying on 90%. I don't think I need to explain what happens when you don't pay on 10% of a $240 million debt. When you leave that's $24 million, we aren't paying interest, it's compounding, it's accruing. So if David, if at our next meeting we could look at, I'll bring the numbers. I'm happy to bring all those numbers to us, what that will mean in terms of what that levy would look like. But I would love if we could please discuss that at our next meeting.
Absolutely. In fact, I have some materials. I think I've been doing some of the same thing. I'll send some things to you. I completely agree. By changing the this is not really a discussion about changing the rate of return on the assets. It's about changing the discount rate on the liabilities. And that is the big, I think, confusion that's caused by pension accounting. You raise you raise the discount rate, you raise the rate of return. As a municipality, that's also the discount rate on your liabilities. So you artificially make your funding level look better by raising the assumed rate of return. And I just, Natasha, also, as a follow-up, and I mentioned it when you sent it today, it appeared to me, but I didn't spend a lot of time on it, that those pension contributions that were in that report were assuming our asset levels at the beginning of the year. And obviously the markets, equity markets and bond markets, are both way down this year. I really think it might not be common practice, but we are so far off of our expected rate of return. I think that we should understand what the right budget number, cash contribution number is using the current asset levels, which, we started the year with 600 million worth of assets. I don't know if you get current reporting on what those are, but the S&P is down 17% for the year. Bonds are down over 10%. International is down more. We could easily, I think we want to look and see what's the current asset level. You can do the math. I think I've shared some of my back of the envelope math on what our current asset numbers must be. But I think that's really something we should get the appropriate numbers on and look at what should our pension contribution be to get to. And I agree with Claire, 100% funding over a reasonable period of time. But also, let's not start with the wrong beginning point.
And a couple of things here. We are in the year 2022. So at what point we pick up? So it's always that gap, at the beginning of the year. One thing. Second thing is in terms of rate of return. Even I got the questions from the press. It is, we have a very bad year. What would happen? How that impacts this thing? We take the 5 years and kind of smooth out, So 1 year, good or bad, doesn't impact, entirely one way or the other. And that's why we have to take into consideration and kind of what we call a 5-year smooth average. With a 20% corridor, I think we touch on that a little bit more, kind of actuarial science, and we can have the actuary come on to and explain. And what that 20% corridor means is the actuarial value of assets cannot be 20% more or lower than the market value of the assets. So they're still trying to kind of, keep the actuarial value as close to the market value, even after doing this smoothing and whatnot. But yes, definitely in the past, I know that the council has kind of been looking at this for the last 15 years. They have received the numbers. But again, when you see the numbers, like if you say, okay, we want to go with 100% and 6.25, it could be like extra $3.5, $4 million additional tax levy. And are we ready to take on? That is the kind of council has to look at it.
Okay. Councilmember Kelly.
Thank you. Yeah, I think it'll actually be more probably this year, but I'm prepared to argue that we do spend that money. I think it'll be closer to 4. But could you also speak a little bit to the state consolidation? I think fire versus, I know the police are still in hearings, right? Regarding and what that will do to the assumptions. I think that, can you speak to that at all?
Right. So what has happened is, as I heard, and again, we're still waiting for our first report from the fire investment pool. But fire, yes, it's kind of 99% of the pension funds has submitted their assets. So obviously, it takes a lot of time because of hundreds of pension funds giving in. In police, yes, there is some legal. So obviously, Evanston Police hasn't kind of given their assets yet. One of the things which they always argue about when they were kind of going to go with this consolidation, and they say, look at the IMRF, how that's handled, with the one central agency for investment purpose. Yeah, pension boards would still make the decision about disability and whatnot, some of the operating expense. But so that was their argument. And so obviously, as I mentioned earlier, some of those communities say that, okay, we are using 6.5 or 6.75. How about if we raise the rate to 7%, because we might have a better returns on our assets with the consolidation. I don't know the legal outcome or the status where it is for the police and when would it happen. Only few funds, I think, maybe under 10% in terms of the police side, yes, have kind of given in their funds. But most of them haven't. In the fire, it's most of them as given with a few exceptions.
Okay. And is there litigation on that point? I believe there is on the police. Is
Well,
that our pension board or is it's most?
They are party to that, I think, but it is originally initiated by the other pension board, pension fund.
Yeah. Okay. Look, I think this is what are different alternatives for funding is a perfect discussion, especially at budget time for next meeting, because this is increasingly one of the biggest items on our P&L, on our income statement, whatever the municipal version of that is. We understand it and what the options are, but again, I would press to start with the actual asset values, not a theoretical beginning of the year asset value, to really understand what that, what the appropriate contribution is to get us to maybe 90 and 100. And Sherry?
Just to piggyback on Claire's question, when the consolidation does take place, how are they going to reconcile, if someone's using 6.5, someone's using 6.75, how are they going to make everyone whole when they consolidate it?
I believe that they would have their one, just like IMRF, they have a one actuary for all the funds. And so, yeah, they would come up with the one rate.
But then we go in with our balance. So if we fund a little more this year, there's still an advantage to our fund.
Right. It is like they still manage individually, like in IMRF, City of Evansville's account based on the claims, history, employees, whatnot. Same thing with the.
So we may not have a choice of the rate going forward.
I believe so, yes.
Okay.
So I think that we're expecting better rates with the consolidation is, right? Sure.
Yeah.
And I would recommend for our next discussion, because this is so important for for budget discussion and budget season as we look at the 23 budget, that David, maybe we can get one representative from fire and police to at least be here to participate in the conversation from the pension boards, maybe.
Sure.
Okay.
We can think, maybe we can talk about what the best dynamic, the best members are for that.
Okay, we can maybe talk
about. We should invite for that, but I agree. And again, we don't have to use the same rate of return for the discount rate. That's my concern. You artificially start deflating the liability and you think you're in a better position than you are. That's
so Hitesh, what was you said we kind of smoothed out the 5 years. Do you know what the 5-year return has been about?
I don't know, but you would see that in the report, I think, in which page, I don't know. They have the numbers in that detailed reports, I think.
Okay. So why don't we go through this in the next meeting? Excellent point. What are our options? What have our returns been? Maybe we can work out what the summarized agenda that we would like people to help us think through in the next meeting. But I think that is a number very much we need to lock in for this budget cycle. What is our contribution, but also more importantly, how is that going to play out over, to get us to 2040 based on current assumptions? How do we understand the pace at which contributions are going to affect the budget in the near and medium term? Okay. All right. Good. So so we will work on that expanded agenda to talk about pension valuations, but Hitesh, I do believe we're going to want to understand how unusual would it be to use our deflated value of assets. This is an unusual year, right? It's giving back some of the outperformance that happened in the last few years. And, what's the impact on the number? Because I agree with Councilmember Kelly. It's probably a bigger number than we think it is, especially to get to 100, but also to take into account that our assets could be so far off of where we anticipated they would be at the end of the year.
Right. And this was, as I said previously, the council members, yes, kind of in principle like the idea. Even I floated idea like some of those communities, I don't know how many use it, maybe a couple, but 15-year open amortization, But we looked at the difference. What would happen? Suddenly, yes, in my first couple of years, my tax levy would go up by $3 to $4 million.
Yeah.
And obviously, with the pressure from the community not to raise the taxes, obviously, yeah, we had to kind of. And still, as I said, if we compare to the most communities in Illinois, even you have seen some of the rates, and these are the Foster and Foster, our actuary, they have lots of clients, including, I think, not Shambhala, but so many others. I mean, this is pretty much their use. And we are using, as I said, 90% level dollar method, contributing more money. We contribute 1.5 to 2 million more than the state minimum. There are communities you would find in Illinois which they are using the state method, minimum required. Yeah. And,
right. Exactly. Well, and that's why I think we are. Look, we could be a lot better funded on police and fire. We're better than a fair number, right? Sort of a decent house, But at any rate, people using larger discount rates pushes. That's another. What's your long-term goal of funding? What discount rate are you using? All those push contributions out to the future. So that's not what we're looking to do. It's a legally binding obligation. Let's be clear about what's a decent path to get to our goal in a realistic way. So I view raising the discount rate as something I would not want to do. Raise the rate of return. If we're going to use that for the discount rate, we're just going to push more off into the future. That's the way the math works.
I fully agree.
So, okay. So we'll work on a good agenda for this, and it's perfect for budget season because it's an increasing amount of funding that's required going forward. And where's that going to come from? So, anybody else have anything you'd like to add on the pension actuarial valuation point? Okay, great. Good discussion, and we'll follow up on that more in the next meeting. So on to the status of the remaining 2022 property taxes. I'm sorry, status of the general fund balance. Atash, saw your presentation. Would you like to summarize that?
I did the presentation. I think we have Clayton, our budget manager, and I think he can go over some of the things and then ask any of the questions about that.
This is the same one from last night.
It is the same one from last night.
Same, yeah.
Do you want me to pull that up on my screen, or?
Yeah, if you can, or Jess, can you do? I don't know, whoever can. Yeah.
And I know that the council members for sure went through this last night. So if we wanted to do it on a summarized,
it could be quick. Yeah, as you right. Yeah, council members have seen these last night.
Yeah,
can definitely go through it in an expedited fashion.
And I would say page 8 is the key for me on the projections going forward, not just this year, but a critical element is not just where we are today, but
we can definitely zoom to that slide. So I think most of you saw this slide last month anyways. It's a general summary of where we finished 2021, excess reserves coming in at 10.7 million. Below this 10.7 million number is a number of things that the city council has committed that 10.7 million to this year as unbudgeted. There's transfer to CIP for waste transfer station, transfer to CIP for some maintenance items, fire truck purchase, Beck part improvements. And then last month we talked about the solid waste $1 million transfer to help avoid a property tax levy increase in that fund. So moving forward, we talked a little bit last night too about the idea of considering how Evanston's 16.66% fund balance policy stacks up against a number of other area communities. We got a lot of information, a lot of thoughts on this topic, a lot of discussion around this last night as well as to whether 16.66 is the right number or not. Do you want me to pause for questions throughout?
Quick question. Why? I'm just curious why we don't have like our surrounding communities like Skokie and Wilmette here. What are those?
I could not find. What I did is I went to the budget items. I could not find for Skokie, but that's why even closest one I got the Niles, Des Plaines. Obviously sometimes I don't know whether I can compare Evanston to a Wilmette or Glencoe, and maybe, but at least, and frankly, I went through wherever I could find, looked at their budget, financial policies, went through.
Skokie wasn't available?
Skokie wasn't, at least I could not find, but I think they are at a higher level because I believe during the 2020 COVID time when we inquired about when we took the furlough as the employees here, and they said, yeah, we did not because we have a healthy fund balance in the general fund. That was my kind of recollection. But I can, reach out to the even finance director. Yeah. But then that's why I went like a couple of towns down, Des Plaines, Niles, and some of the comparable, like Schaumburg, same population, Naperville, same population, and obviously Bartlett and Evanston itself,
Glenview might be good to know as well, I think.
Yeah.
All right, we can definitely dig into that further, see if we can capture a couple of our neighbors. This is the same slide as before, just adding in what it would look like to increase Evanston's fund balance reserve in the general fund. This is updated to the end of July. It shows we're having a pretty good year. Revenues at 70% of the budget, expenses tracking at 56% of the budget. All in all, some of the major revenues trending high: athletic tax, state income tax, personal property replacement tax. We've dug into a number of these as well and made adjustments moving forward into 2023. Some of these we expect to stay up there. Other ones like the sales tax and home rule sales tax, the use tax, things that are kind of on track, we've made less adjustments to as we're working on the 2023 budget. And then a handful trending low. We've already talked about the property tax issue and the delay with the second installment. So all in all, we talked about this last night as well, but we're projecting at this time about a $7 million surplus, revenues at about 107% of our budget, expenses at about right at what we've budgeted. So what does all that mean? This is the slide that I think that you were looking to get to, Chair Livingston.
Sure. Can I just make one comment on the prior slide briefly? Mm-hmm. I think that it's important that, yes, it's good that we've got a $7 million projected surplus, or maybe even slightly larger, but there are some very unusual items affecting us here. Particularly inflation, I think, has affected some of our revenue streams faster than it's inflated. We have some locked-in costs. We've got, especially on the cost side, and this comes through on your next page, but I just wanted to address it here. The positions we're talking about adding in, the fact that we've got 4 union contracts up for renegotiation, the pension that we just talked about, how is that going to impact our expenses going forward? New programs that we want to fund, and then, delayed capital, and then ultimately higher interest rates. You might be able to, defer a bond deal to some point, but at some point we're actually going to have to start, paying the relatively higher rate. So I just want everyone to be tempered, and it shows it up on the next page. I think it's good. It's good that our reserves are higher. I would encourage us to take adopt a higher level of stated reserves, but there have been some fortunate circumstances, especially on the expense side, I believe, that are lagging, that will result in higher inflation going forward. So let's, and that sort of goes into the next page, where I think you're showing potential for deficits coming up. So good where we are, but let's, I think, not get too excited about where we are, because some of it is timing of revenue versus expenses and things that we are going to very much have to manage through. So.
And may I just, one comment, I think I agree with everything that David said. I do think there's probably also surpluses that, I don't know if the full surplus in terms of positions is here, because we've obviously, there are many positions that have not been, that were budgeted for, but we haven't spent on. So a full accounting of that, of positions never filled, as well as, every year I've always been arguing that we include the lag pay line item that used to be included, which usually is between anywhere from $1 to $3 million a year, and when you have a regular year, between when, of all the 800 plus employees, between employees that are either don't get hired or that take several months before you fill the position. So that got eliminated as, it's in a sense sort of revenue or surplus. I think that needs to be put back in so that we're realistic with our residents in terms of funding that's needed. So lag pay plus, I'd love to have a full accounting of what is in effect surplus due to all of the absences. Additionally, I will say at the end of last year, transfer tax, for example, that was not accounted for when we were in the middle of our budget season. It was only after we passed and I was able to, through emails back and forth, I found out that we actually had, which was not accounted for when we were assessing what we needed to levy. We had budgeted for $3 million in transfer tax, but we ended up at year's end with over $6 million. And so that was a $3 million surplus. So I think there are still some items that will actually show that our surplus had increased. And 100% I agree, we have to be really cautious and conservative. I'm obviously going to be lobbying that any surplus we have goes to 100% funding on our interest on our pension obligation, so that doesn't continue to expand. Thank you.
And just regarding that real estate property tax transfer performing higher than anticipated, that is included in, since it's one of the major general fund revenues, it's included in the $7 million projected surplus this year. And that's one of the more top performing revenues helping contribute to that. And then it's also what contributed to the 11.9 million in excess reserves last year as well. So it's that 3 million excess, 3 million surplus in real estate transfer taxes, part of that, what's contributed to that excess fund balance.
So Clayton, thank you. And by the way, welcome Clayton. I'm really
thank you
that you're on board here. It's so great to have your expertise and your experience with us. It's really
welcome. Yes, thank you.
And Clayton, so is that a projection on our transfer tax? Because I know I get those reports every week and it says in process. So we haven't actually collected on many. I look at those very closely every week when I get it's just the first ward, but all the transfer taxes, and rarely are any of the transfer taxes actually completed. So is this just a projection based on last year?
This would be for this year, and you can see, I think real estate, correct me, Atesh, but it's probably rolled into this other taxes line.
So if you see that a couple of line items, as Clayton is mentioning, other taxes, we are projecting at 113%. One other line item is 108% charges. So it is part of that general fund where you see that, okay, we would have a higher income. And again, I would caution, we have as low as when they came out last reassessment of 2.6 million in transfer tax. And we are waiting for this triennial assessment. If it goes south or something, that impacts. We were in a limbo for almost a year until all the appeals were settled, and then we started seeing the big commercial transaction. And we kind of suffered during that time frame. And again, this year, county is still working on, I don't know where they are with their final tax numbers and EAVs and whatnot, but that impacts our transfer tax revenue. If it is uncertain, if it's high assessed value, that does impact the commercial transaction, and which is a big source of income for us.
Sure, it's going to be. I know that new those valuations will have an impact, but I just want to point out that it was post budget season. We did come in with twice the amount that we had budgeted last year for our transfer tax. So I understand this year this can be impacted in a different way. Thank you.
Yeah. Councilmember Reed, I think you have your hand up.
Yeah, thank you. I just wanted to, since we were discussing inflation and how its impacts on our budget, I did want to note that a number of our sources of revenue, particularly our major sources of revenue, certainly aren't recession proof, but certainly adjust with inflation and particularly, such as sales tax. I think, unless we see a slowing in spending, with that, I don't think we've quite seen yet, particularly on the kinds of goods you'd be buying in town, such as household goods with your necessities. I think that Evanston's in a pretty good place. And then, we're also a town that is quite affluent. And so because we get our income tax disbursement from the state, we've seen that pretty steadily grow as well. Even through the pandemic and the recession that was that was caused by the pandemic. So,
I mean, absolutely, council member. Last week, I know we had one of the, I don't know which one, but one of our finance directors, one of the town, like cautioned that okay, at some point we would come back to the normal. It could be, not in 2 months, 3 months, but maybe 8 to 12 months, maybe next late spring or the summer. And if we back to the 2.5% or 3%, and as you mentioned, council member, most of our revenues are based on the gross fees or gross, revenue. Those would go down. Now, if we have like 4 or 5% reduction in those tax revenues, even if we go up then, we stay stable or go up, it might take some time to get back to our normal level of 22. So we have to be cautious. Yeah, the inflation has been, if you look at the past CPIs, maybe 1.5, we may be ever as low as 1.5, 2, 2.5. And if we get back to that and lose some of those sales tax, use tax, amusement, liquor tax, all those taxes which are based on the amount, the value of the product, we will have to kind of take into account and make sure that we don't do kind of a over budget that,
I just had one quick question, Clayton. Can you go back? You said our revenue is 70%. Is that normal that 70% of budget, is that in line with previous years?
It is a little bit higher, and there are a couple of things. We have some seasonal revenues, big one. Like we got 55% in property tax, first installment at least, right? So that's the one thing. Second thing is most of the transfer tax, building permits, that happens in spring and summer, So by July, August, and same thing with the recreational fees during the summertime, our services. People pay in March when it starts springtime, and then up to June, July. So yes, those numbers are there. Typically, in terms of revenue and expense net, last 3 months of the year, October, November, and December, in a normal year even, that where we won't get any property tax money, because even normal course property tax used to come second installment in August, September. And then October, November, and December, there is no property tax. There's a 1 month with 3 payrolls, which is a September. So obviously that is like a $2.5 to $3 million gross payroll. And then November, December, weather related. If we have a 2, 3 snow events, that kind of racks up the overtime in public works and police and fire and others. So yes, we cannot kind of extrapolate these numbers and say, yeah, we would have this number by the end of the year.
Okay. And we've talked about trying to build a long-term planning model. And again, it's just building in those assumptions, what's reasonable for these lines going forward to identify, structural issues that are emerging. So if we go to your next page here, I think, this is sort of, I know there's some general assumptions here, and maybe we can, as we go through budget season, talk about these a lot more. But if you just take these on face value of what you did, I think that net number shows that our 7 million becomes, is it true, -6 next year, just based on your assumptions and sort of growing from.
And just to walk you through some of these assumptions a little bit, we've already talked about, well, from left to right. So 2021, this is the excess reserve that we've talked about, the 11.9 million from last year. This year's budget, the FY 2022 budget, was balanced with 1 million from that 11.9 million, as well as 4.5 million in ARPA in order to adopt a balanced budget this year. There was 5.5 million used from ARPA and from this excess reserve in order to balance it. This is the projection
to be clear,
that we just
revenue loss. That was revenue that we anticipated from the parking fund and other funds that in a normal year we would likely experience, the money that we would realize.
No, why? Let me just kind of explain this. How, like we balance 22 budgets, and council says, yes, we will give you $4.5 million, 4.25 million from ARPA funds to you guys, and which would fall under revenue category. So we will find in terms of the treasury compliance. The problem is, from accounting standpoint, you can book the revenue only for the eligible expense. So even if the council says, yep, here is a 4.25 million, talking to Sarah, I think our total positions which are eligible for this expense are under $2 million. So for 22, we would be only able to book little under $2 million in revenues, even though council has approved 4.25, because that's how the grants work, that the revenue is booked only for the eligible expenditure amount. And this works with other grants too, from the accounting standpoint. So we would lose roughly $2 million in revenues from ARPA fund this year in 22.
So then looking at this column, then this is the projection, the 7 million that we just talked about. If we recognize that $7 million surplus, $7 million operating surplus this year, we're looking at an excess reserve balance of about 18 million over general fund policy. Looking ahead to next year, that's where we started to make some assumptions. So this is the biggest assumption, is an increase in salaries and benefits based on the Baker-Tilly study that went to committee last night. It considers that all of our union contracts are up for negotiation, the potential for COLA increases as well, we anticipate, and as well as new positions that are being requested both through the Baker-Tilly study and from other departments as well. Looking at a pretty significant increase in salary and benefits of about 5 million. We've already talked about revenues and how inflation has contributed to some record revenues here that we don't anticipate increasing significantly over 2022. We have adjusted those revenues based on what we're seeing this year. So you'll see from 2022 budget to 2023, where we're at right now, we think it's going to be pretty flat. But again, this 117 million did include that 5.5 million in ARPA and in excess reserves. And so essentially it's a structural deficit of about 6.3 million. And we would want to take a look at using this excess reserve in order to cover that amount. Looking beyond this year, very high level assumptions. We've applied a 3% estimated cost of living increase across the board on expenses, as well as a 2% increase to revenues, being fairly conservative there, and a 0% on the property tax line. And you can see we've got a bit of a structural deficit looking at 2023 and beyond, where we would need to look at using some of that excess reserve balance in order to help create balanced budgets moving forward. So I think that covered most of our assumptions here. I don't know if there was any questions on this slide.
So I would also imagine you could have a pension number that's not high enough in here as well, right? And
based on the discussion we just had, yeah, absolutely.
But speaking for the group, those negative numbers cannot happen, right? I mean, we have to come up with, however it is, one way or another. I think the point of this committee is to make sure that we don't, boldly walk into a structural deficit. How do we, make things work? But I would say it starts with using the right pension numbers as well. And I imagine that we'll see what the right number is.
Right, Chair Livingston, let me clarify. Yeah. Pension expense numbers have no impact on this. It's the contribution, we book the revenue and expense. As I said, and I think the actuary Jason clarified, that the communities are worried about one number.
No, I understand the contribution.
Right.
Expense. Okay.
But even contributions have no impact on this income statement.
The assumptions do.
No, I mean, as far as this projection,
expense in expenses, isn't it?
This is the 4-year projections of a general fund. What we do is required by the accounting entries. When we levy, say, $10 million for police pension, it is included in the revenue, and same 10 million is included in the expense.
Understood, but what we levy is highly dependent on whether we go 6.25 or 6.5. That impacts what we levy.
That is different, but it has no impact on our general fund financial. That's what I'm trying to say. The contributions or pension expense has no impact. They are outside of the general fund.
Okay, I guess I need to understand that better, right? Because it sounds like,
and we can try to cover that. As I said, let's focus on the next month meeting. One item, which is important.
Okay, I assume that the pension contributions were included in the the public safety costs, and you're saying that they are, but there's
They are
we need to understand that
included.
more.
They are included on both sides. They are
Yeah.
included as a pension, property tax, as a revenue, and they are included because as an expense too. So it's a no net impact on general fund. It's just for the accounting purpose in and out.
But you have property taxes here flat. Are you saying there's right? You have property
Correct.
taxes flat. Is that where the pension levy is?
Right, pension levy is there, but we're
Right.
still showing that, and we are still showing the contribution to go up like expenses. And as Clayton said, these are high level assumptions, you
Okay.
know.
So
We just
So we got to sort that out. But I think if we're going to levy, then is that assumption on property tax correct? If actually the pension required contribution is going to go up, right? So obviously that's a sensitive issue, right? But anyway, we need a functional multi-year model that we can understand and make sure that those deficits do not happen, right?
And again, I think the one thing which Clayton, I think you did clarify or not, that some of the items which council has approved so far, 5 or 6, they are not accounted for, right? Or are they?
No, they're not accounted for here. So this 18 million in excess reserves, it doesn't include the 3 million that's taken out for these items that were mentioned up here on slide 2. So the 18 million is actually closer to maybe 15 million or so in excess.
Okay. So if I could highlight more, then don't get excited about the current year 7 million surplus, because we have some structural issues we have to deal with.
I think that's the biggest concern, just given this bump right here, and you know, Council Member Kelly did talk about that vacancy rate, and there are a number of positions in our budget that are vacant, and Hitesh talked a little bit about, you know, that costs for payouts, and we hire people in, not always at the starting pay as well. So there's a little bit there that you do make up, but with a budget of 74 million, if you have a 2% vacancy rate, you're talking at about 1.5 million in savings from salaries and benefits there. If it's 3%, you're talking about a $3 million annual savings in salaries and benefits. So you can't quite make up the full structural deficit just relying on that alone, but it is definitely one piece of how you can help cut into these numbers.
And the thing is, as Clayton said, it's not always like, okay, if I leave today and you say, okay, there was a 3-month gap by the time they hired my replacement. But when I go out, there is a vacation payout. And then current labor market, I mean, what we have hired during the first right now, including the latest hire, Clayton, they are all making more than their replacement.
But lag pay used to be, I mean, I don't think this is such an unusual concept. Many cities incorporate lag pay into their, when they do their budgets and consider the revenue versus expenses, lag pay and it used to be on the city of Evanston too. So this particular year, we have a huge, we should have a very large number.
Right. And we can include that if you want to see with the, one more scenarios that, okay, we can say 2% vacancy rate, and see where we are. And just to give you, like, I remember, I don't know how many years back, maybe 8-10 years back, one time we budgeted only 99.5% of the salary, 0.5% less, because of this kind of thing that, okay, we have some overlap, we have some months, and finally we were over the budget. And why we was over, we were like analyzing that because of the big payouts, because particularly when somebody with 15, 20, 25 years leave and they have 50, 60, 30, 40 days, whatever, their vacation bank, and particularly those benefits are more generous for the police and fire side with a lot of different payouts. It's a substantial amount.
So I think for our next meeting, we want to focus on pension. We want to focus on these HR ads, right? What are overall salary increases? What are open positions? How are those affecting the budget? Because I think if we understand the salary and benefit side, we understand the pension side, we're going to be pretty far down the road in really understanding how this budget is going to come together.
Don't have much else in here. This was just, we built out 2 other scenarios based on a slightly larger and a slightly smaller surplus for FY22. This started to get into some of those potential cost increases from some of those HR items, looking at a 3%, 4%, 5%, 6%, and 15 new positions versus 25 new positions, and what the potential add would be to the budget based on some of those scenarios as well. For the purposes of what you just saw, this is the number that was dropped in. So it was a 5% across the board raise, and a 15 new positions being added to the budget. So that's what we used in those assumptions.
Okay.
Long list of summary of major items. I think we've already talked about a number of these. And budget calendar is an item later on this agenda.
Yeah.
So.
I mean, why don't we just do the budget calendar now, and then we can go back. We can go back to I think the property taxes. We're about out of time, but I think the property tax discussion is pretty quick too. But
just in terms of budget calendar and what we're looking at, we're hoping to post the budget, working extremely hard to post it basically 1 month from today, October 10th on the website. Proposed budget presented at City Council meeting on October 17th. Public hearing on October 24th, the Truth and Taxation hearing on November 7th, earliest possible adoption right before Thanksgiving, and then our year begins. I think that there's a number of items that came up today that you hope to talk about, including the bond and the letter of credit and which route we go, as well as property tax contributions and what those look like. They probably won't be baked into the budget that's drafted and presented on October 10th, but we do have time after the initial budget's posted to make whatever changes we're directed to make after that initial budget gets posted.
Just to clarify, we're not talking about a letter of credit. We're talking about a line of credit, correct?
Excuse me. I'm sorry.
Okay. Yeah. No.
Line of credit.
People have said letter of credit.
right, Councilmember Kelly, you have something?
Yeah, I really think, given that, this is a new committee and it's a very important committee, we're finance and budget, we're in budget season. I would like to put forward that we meet in October and November, that we meet twice, just during those 2 months only during budget season.
Right.
Fine by me.
I certainly agree. In October, we need to, So why don't we think about adding a meeting to whomever can make it. So what would be, I guess, in 2 weeks? Why don't we circulate what the right time for the next meeting is? But it sounds like if something's going to get posted on the 10th, we need to meet before then. Jonathan?
Let's also talk about what role this committee is going to play in the process. Mm-hmm. And if we're getting together just to have a meeting, I like you guys, that's great. But are we going to be asked to review and approve the budget before it goes to council? So I think it's important we define this committee's role in this process.
I do think that is absolutely the role of a finance and budget committee, is to be reviewing the proposed budget. And I know it's a new committee. We're just barely one year in, but absolutely. So I agree with David that we should schedule a meeting before. I think Clayton, I think you said October 17th, it would be presented to council. So I would recommend 2 meetings in October. I don't know when we're currently scheduled.
If this committee's really going to add some value here or be a part of this process, it would seem to me to be appropriate for the proposed budget in draft form to come to us before October 10th, which is when it's published on the city's website.
I would agree with that. I would agree with that.
I mean, it might be tough for us in terms of timing. We are still working with the other department. This is kind of an aggressive timeline, even at this stage. I think, this has the report, so it's nothing set in stone. And you have just like council and all the council members, during the next 6 weeks, talk about it. We can have, talked at the budget and finance too, because nothing is adopted yet. And we can incorporate this committee's contribution as well as we go to the ward meetings. But to come before that might be too hard. We are like really kind of and some of those departments, we have a lot of turnover in some of the department, number 1, number 2. So they have a tough time coming up with these, kind of some of those final numbers.
What if we?
Tash, I'm trying to clarify. Are you saying we won't be able to have a draft by the 10th, or are you saying you can't even?
Right, I would stay with the draft budget, which would go out to the council and then the finance committee, and then finance committee can meet, along with the the council is reviewing.
Here's what I say. How about if the budget's going to be released on the Tuesday and I think the 10th is a Friday, that's typically, we typically release the budget. It's on Friday. So if we release the budget, Friday, what I assume is Friday the 10th, then what if we met on that following
Monday,
Tuesday? I'm sorry?
Monday.
That's Monday. We're scheduled to
Oh, the
meet the
10th is a
day
Monday.
after.
Okay, well then even better. What if we met on?
So why don't we meet the
Yeah,
4th?
okay.
Do you want to meet on the 4th or the 10th? Why don't we meet on the 4th?
Well,
Just whatever you have.
Okay.
I can just,
So I would like to say it shouldn't be released until you met with finance and budget. Like, what's the problem with saying you'll release it? You're going to meet with us. Let's schedule the date that we review it. It's released to the finance and budget. We review it, we discuss it, and then you look at the date that you release it.
Well, at that point, it's released. If we review it, it becomes a public record. It goes in the packet. It's released that day.
So are you
Again,
saying, Claire,
I
that
agree
we
with
should
this.
release it then?
I'm sorry, I didn't hear.
I'm sorry.
The timing of events to me depends on what the role of this committee is. And are we
Jonathan,
being asked to bless the budget before it goes to council? Is that what we're all
finance
assuming?
and budget, so we should have our recommendations and we should be weighing in, and that's the point of the finance and budget committee primarily. It's about the budget, the annual budget. So I would say that yes, we should, I would say decide when you're going to release it, but figure it so that it's post meeting with the finance and budget committee. So if you're looking at now, and you said it was aggressive, so maybe it really isn't going to happen on October 10th, but that's what you're shooting for, then why don't we meet the first week in October and then again, 2 weeks thereafter?
That works.
Chair Livingston?
Yes.
I'm not sure who said it in all of the chatter there, but once it's released to us, then it becomes a public document. I think this is unfair to the staff. The staff has traditionally had a release date that it goes out. It goes to the council, it goes to public, it goes to everyone who's interested in our budget. And then we do spend the next 2 months working on the budget. So while I appreciate Claire's point on this, I also appreciate Jonathan's point on this as well. And I think having this preliminary draft budget issued is not fair to the staff. They work up until the final moment on this. If we want to discuss it, then let's have a meeting the day after and dig in. Okay. But I am not supportive of having a soft opening to this. That's not how we've done it over the years, and we've had plenty of time to chew on the budget and to make changes. And I also do think that we're throwing a curveball at the staff by asking them to. I mean, they've been working on this with a particular date in mind for quite some time. Okay. So I agree the committee needs to discuss it. I agree with Jonathan that we need to refine our roles. I think some of our role here is a blend of looking at very high level issues that we've been discussing tonight, as well as immediate issues. But I say that what we should do is let the staff release it when they have all of the information. Hitesh is absolutely right. We've had a number of significant senior staff people leave. So getting this budget put out this year is even more difficult than in other years. So let's have our meeting as soon as possible after the official release.
Okay. And we're meeting on the 11th anyway, right? Our next meeting is the 11th. So it sounds like we should.
After. There it goes.
Yeah. And if it's not available, we'll just get an update on where it is. And then maybe we meet 2 weeks after that. But if it is just a beginning marker. Okay. I think this point of what our role is something for the council members. Obviously, it's not for the 3 community members to decide. It's what, it's what the council.
It's described. It's already documented. This has been memorialized in our, in documents what our roles are, and it is to review budget. But I agree with you. That's fine. So whether it's officially released to finance and budget or officially released on a city website, it doesn't. I guess it doesn't. I didn't mean to say I wanted to undercut that. It doesn't matter to me. But I just think the point is that we discuss it before it goes to council, so that at least council can get the feedback. It's very unfortunate that this city has not had a finance and budget committee in the past, but now that we do, I think it really is important that council benefit from feedback. So that's fine. I think that's great. But I would recommend that during budget season that we do try to meet, I would say October, November twice. I think that would be appropriate.
Looking at the calendar here, if we're keeping an eye on Tuesdays, both the Tuesday the 18th of October and Tuesday the 25th of October, there are other committee meetings scheduled those evenings. So Tuesdays would not work.
About Wednesday or Thursday?
Or Chair Livingston had the idea of circulating the Sign Up Genius or something like that.
What if we just made our meeting like maybe 2 hours, a little longer, and dedicate a lot of it to the budget as long as it's already scheduled on the 11th?
Okay. Maybe we should discuss this, offline what the right meeting cadence is. Maybe there's an extra meeting in there in October. I don't know if we can solve it right this minute. Okay. So anyway, but it would be good, a point in meeting before the 10th would be to really talk about these two issues of what's the right pension and what's the right headcount number. But that's not critical. Sounds like we have some additional time afterwards to, Councilmember Reed. Councilmember Reid, you raised your hand. Maybe.
Oh, that was from a while ago. I guess we're there. I was the person who mentioned that originally, so I'm in agreement with Councilmember Wen. I think we settled on the right cadence.
Okay. So we're going to meet on the 11th as planned, and we can look at in the interim, is there another meeting to add, like maybe 2 weeks or so after that? And then we can decide then if there's something to add in November. Why don't we take that approach, and we'll work for a date. We'll try to find a date that works for everyone after the budget's posted.
Great. That sounds good.
Okay. But it would be good to understand especially on the pension side, are there updates you could send around, Hitesh, and on the HR side. All right, and then the final item was just the status of the remaining property taxes. I believe that's just a timing item, Hitesh?
It is a timing item. We don't have any specific deadline from the Cook County yet.
Okay.
Do we have an estimate? Do we estimate, it'll be a month or 2 months or 3 months late, 6 months late?
It could be a long delay because, as I said, Cook County came up with some bridge financing from some of the distressed communities. So I think it might be a few months. Originally, we thought maybe a month or two, but when they came out on their own for this financing, I thought it could be a December, January.
Hopefully it's not into another fiscal year. I guess we just book a receivable, but
we will book receivable, yes.
Yeah. Okay. All right. If we're done with that, then we also have the status of the reparations fund as the final item on the agenda this evening.
The reparations fund, I think the committee has been getting the numbers. I think who is there? Councilmember Reid, you there on the committee, reparations committee?
I think he dropped.
But yes, the thing is, I cannot tell the exact revenue because of the Department of Revenue. We have only one, the cannabis shop. And so, but we kind of give the estimates to the reparations committee that what are the numbers, monthly collection, annual collections, and those kind of things. So they can kind of get some idea about the funding the applications for the, new people.
Okay. So maybe we should move that discussion more for when the next meeting.
We can discuss, but as I said, if you ask me, what is our revenue? And I might be hard pressed to give it is 300 to 600,000.
Mm-hmm.
And you may not like it. I'm like, okay, that's too big. But the thing is, we have this issue with Department of Revenue. In the last couple of years, we asked them 6-8 times, and they say, yes, it is still out that stand that you cannot disclose the revenues.
Can I ask one quick question before we close? Just because I travel a lot, the meeting dates are only up through November on the website. Should I just assume it's going to be the second Tuesday of every month going forward?
Yes.
Okay, I just need to book that in my calendar. Okay, thanks.
We approve, Sherry, at the end of, at the start of the new year, we approve the next year's calendar of dates.
There's no meeting in December. Is that because we don't meet in December, or is
It could be maybe because after the December, generally the budget is passed right by Thanksgiving. So maybe that's why, yeah, we kept, we will check. But yes, Councilmember Wayne is right that the committee approved the calendar, for the 2022.
Okay. All right. Seems like we might want a December meeting as a recap of the budget that just got passed, but how the council members feel about that?
Yep, I think we should.
Yeah, so I think we need to add
That makes sense.
a meeting, at least for right now. Just add the one meeting for December 6th, 13th. We'll add one for the 13th at 6, and then we'll figure out next year. We'll lock those in at the appropriate time.
Okay.
All right. Is there anything else? All right. Good discussion, lots of moving pieces, so we'll get them into a budget, into a workable budget.
And the one thing in general before, yes, this year's budget is so hard because the main cost is personnel with the union contracts.
Yeah.
Not expected to wrap up by the year end. So we will have a fair estimate there. This Baker Tilly study about the staffing and comp study, and the current labor market. So these all things combined, kind of it does become a little bit harder to estimate the personnel cost.
Yeah. And inflation on top of that. So good. So I guess a motion to adjourn.
So moved.
All right. And seconded. Someone seconded? All right. All right. Sounds like we're adjourned.
Thank you very much. Thanks for an excellent meeting.
All right.
Yeah, very good.
Bye. Bye.
Good night, everyone.
Good night, everyone.
Bye.